have a question for you that you may have never considered before. How much about how you feel about investing is influenced by the year in which you were born? You'll hear us say in this group that personal finance is about 90% personal and only 10% finance. And this is because everyone tells themselves a different story in their brain about money, about investing. And the thing is, everybody's story is different. Your story is going to be different than my story. And we can see that if you just walk down the street and randomly picked out two people and asked them, is investing in the stock market a good investment? I'm guessing you're going to get two wildly different answers. The first person might say, no, investing in stocks is risky. It's a lot like gambling. In 2008, the stock market lost half of its value. In 2020, it lost 30%. And so no, investing in the stock market is risky. The second person might have a wildly different answer. They might say investing in stocks is the best investment you can make. It's not uncommon for stocks to grow by double digits in a given year. And there's never been a 20-year run where the stock market lost money. And so these two people have a wildly different story going on in their brain about investing. Okay, and our story, the story that we tell ourselves, is largely determined by our experience. Okay, and recent studies show that your experience in investing in any asset class or just investing in general is largely determined by the year in which you were born. And so what I want to do is I want to jump into an example and show you how apparent this is and how you can separate yourself from your story and make the best decisions for your retirement. What I want to do here is I want to take the baby boomer generation and I want to show that based on when you were born in this generation, you had a wildly different experience in the stock market. Okay, and that experience changed your story that you have about money. So we're going to break the baby boomer generation in half. We're going to take the early baby boomers, okay, that were born between 1946 and 1954. And we're going to assume that they started investing when they turned 20. Okay, so they started investing in 1966 and invested for 15 years, their first 15 years of investing. They invested $10,000. And as we can see on the chart here, they had a bit of a turbulent ride through this 15-year period. In 1973 to 1975, there was a stock market crash that caused them to lose 45% of their money. And so they began in year one with $10,000, and almost 10 years later, they still had $10,000. Now, if we zoom out, we can see that $10,000 through this period grew to $26,000. Now, what's interesting, if we look at the second half of this generation, they had a wildly different experience in investing. Okay, they started with the same $10,000, but they saw their money grow without really a blip on the radar for 15 years. That same $10,000 grew to $98,000. Now, a researcher that Tony and I often read named Michael Kitces did this with every generation. He split every generation in half, looked at the boomers, the Xers, the millennials, and he found the same thing. Okay, when he split these generations, okay, he found that half of the generations had a great experience in the stock market, while the other half had a poor experience. So up here we see the late boomers and the early Gen Xers. Down here we see the millennials, the late Gen Xers, and the early boomers. And so what's interesting is when researchers survey retirees, survey their risk tolerance, survey how they feel about different assets, late baby boomers and early Gen Xers speak very positively about the stock market. On the flip side, however, the early baby boomers, the late Gen Xers, and the millennials all feel that the stock market is risky. And so we can see the experiences that people have influence how they feel about money. So why does any of this matter? Okay, maybe you're with me that we have a story. We all tell ourselves a story about money, and our experiences influence that story. Well, the story that you have about money, I'm guessing, influences the way you invest, influences your retirement plan. Now, part of our job as retirement planners is to separate you from that story in a sense. Okay, part of our job is to integrate your plan with that story. Part of our job is to tell you where your blind spots are. And so it's important to understand that you might have an impression about the stock market. So for instance, your 15 years of investing in the stock market might have been rough. But that says nothing about the next 15 years. Okay, your first 15 years investing in bonds might have been great. That says nothing about the next 15 years that you will invest in bonds. And so it's important that we unhinge ourselves at times from this story and do what's best for our plan, regardless of our experiences in the past. Okay, hopefully this was informational. Always remember that you don't need more money. You need a better plan. Thanks for watching.